Stream of Master Investor. Glad to be here again with another valuable talk on money, business, and investing. Master Investor is more than an investment management company. My name is Jose. I'm the founder of the company. Our mission is to elevate the financial well-being of humanity through high-quality financial education. Made simple, we look at opportunities to build passive income and true wealth. Today, our theme is how to analyze investment. Yes, how to analyze investments. And we're going to piggyback on our last live streams that we have done this past week. We're doing this the entire month. We're doing a 30-day challenge, and we're going to keep this going the entire year. Okay, but we're going to build the habit of giving financial education to our community every single day so that we can improve our finances. So we have been talking about the importance of building a company and not just a commodity. A company is a brand when it has intrinsic value. And the way we can get intrinsic value is by protecting its niche through trademarks and having the legalities in order for the company and the brand. So it's not just about starting an LLC or company, is about actually protecting and going the extra mile to protect the niche of that company, and as much adding financial integrity or business integrity, which means that the business is whole or complete, is profitable, and it's expendable. We need to really figure out what is our market share, how to understand our clients that are in need of our solution. And remember, there are 8 elements that makes a great business successful. Those 8 elements, we find them inside of our cash flow, business, owner and investor, inside investor triangle, which it will detail the 8 elements of a great business. And I'm going to give them to you right now. Write them down. Number 1 is mission. Number 2 is the team. Number 3, leadership. Number 4, cash flow. Number 5, communications. Number 6, systems. Number 7, legal. And number 8, product. So let's not make the mistake that majority of people make when they start a business. They think the product is the most important aspect of the business, although it is important, because without a product or service, then there's no business, because it's not solving a problem. A capitalist, that's level 5 of an investor, right? That's the top level. That's where we want to be. A capitalist is someone who solves problems, and we are always looking for problems to be solved with a company. So a company is always built to solve a problem in the world. And when we build a company, we want to make sure that it's raising capital at all times, because it's solving a problem successfully and effectively. So it raises capital from the front end on autopilot, from the end users, and also because it's profitable and it's making sales on autopilot by using the systems within the company, because a sound business is a system of systems. It can also raise capital, of course, on the back end through the banks and private lenders. Rule number 1 of entrepreneurship is to stay in business. The job number 1 of the entrepreneur is to raise capital. The number 1 skill is to sell without selling, using systems and smart marketing. Therefore, we need to always stay in business when we start a business, because we are applying the job number 1 of an entrepreneur, which is build a business to raise capital. We are constantly raising capital, not only from the front end from clients, but also from the back end, so that we can expand the company. Then we need to understand how to read financial statements. When you go get our ebook, I added the link in the description of this video, how to build cash flow with the internet, turn passive income on. It has 49 chapters. In today's topic, how to analyze investments, is found on our ebook on chapter 11. So you're going to have a detailed information based on what we're talking about today when you download our ebook. And as much, you're also going to be able to access other assets within our digital course that you'll find the ebook. When you get the ebook, you'll have bonuses that are assets, and we have one of those bonuses to be a financial statement that is blank, and anyone can download it to their Excel or print it out and fill in the blanks with their information. How much income do you make? How do you make your income? What type of income do you have? And what are the liabilities? What are the expenses? What are the assets, right? So the financial statement is composed of 6 words. It's divided in 3 parts. The first part is the income statement. We will find the income column and the expense column. And then we have the balance sheet as the second part of the financial statement. And there we'll find the asset column and the liability column. And then we have the third part of the financial statement, which is the cash flow statement. So the 6 words that make a financial statement in simple terms are income, number 1, number 2 is expenses, number 3 asset, number 4 liability, number 5 cash, and number 6 flow. The most important words in the business language are cash flow, because as a business owner and as an inside investor or master investor, we're looking for positive cash flow. Otherwise, it doesn't make sense to be in business if we're going to lose money or not to make any money, right? We want to be in business to make money in any type of economy because we are prepared for any type of market. And that is a master investor. We actually cash flow even when the economy is crashing. We find opportunities that other people that lack financial education or people that have gotten in trouble financially, they are actually giving us the opportunities that we will cash flow with. And we can obtain those opportunities and those assets with OPM, other people's money, using debt, because we understand that the capitalist mindset is all about raising capital and using OPM, using money, which is debt. Okay, so money is created with debt. That's why debt is tax-free, and we encourage everyone here at Master Investor Community to learn how to use debt, how to leverage it, so that we can invest into assets that produce passive income. And that debt ultimately is good debt because it's making us wealthy. Good debt puts money into our pocket in the form of passive income, and bad debt takes money away from us. There's nothing wrong with having luxury that has debt, that has bad debt, if you will, as long as we have an asset that will produce passive income to pay for that expense of that luxury. So we have delayed gratification, and we focus on building an asset or acquire or invest into an asset that will produce the type of cash flow that we require to pay for the expense of the liability or the luxury that we want to acquire to enjoy our lives. So here at Master Investor, we encourage everyone to expand and to live above our means, because there's always more money to be made as long as we have the understanding of what is money, how it works, and we can focus on building and compound our asset column with real assets that we control. Then we can definitely tap in to infinite return on investment, which is money for nothing. Basically, we have no money into the deal. We recoup the down payment back if we put any money up front to start up the business or acquire the investment. We have recouped the entire capital invested back. However, we still control the asset, we control the good debt, and it's making us positive cash flow. So that is money for nothing. We have created a printing machine of cash flow. Infinite return investment is what we look for on each investment that we invest in. That's what we want. We want to be able to recoup our entire capital back as soon as possible and keep control over the asset after we do that. After we recoup the money back, we still control it, we still be able to collect positive cash flow. That's what we always say, we can actually get wealthy for free. If you're not doing it for free, then there's something missing, because the economy and money works with debt. The new capitalism works based on raising capital on debt. That's why the government is trillion in debt nationally, and they continue to print even more money, and it's not going to stop. It's actually music to the ears of a financial educated investor who is a master investor, because we can also raise capital and print money legally like the government does. So we can actually enjoy becoming wealthy fast. All right, so we also talked about the three, I don't know if we did it on the last live stream here, but we did it on Facebook, so I'm just going to mention it because I guess I was supposed to maybe separate it, but it's fine. We're going to do it in this one. We're going to talk about the three types of income that exist, because we talk about it all the time. Majority of people only work for one type of income, which is earned or ordinary income. Rule number one of our company here at Master Investor is that we work to build passive income and make money work hard. Okay, however, there are three types of income: earned income or ordinary income. It comes from a job, and you get it through a paycheck or salary for the time that you exchange. It's very hard to become wealthy unless you are at the 10% of a certain field that you can make millions of dollars, but you don't have the freedom because you have to show up to do the work to make that type of money. And so, but if it's something that you love to do, then it doesn't feel like work and it's great. So a lot of people have a lot of money, but they don't have the freedom. But if you love to do what you do, then that's your choice. And there's nothing wrong with you working unless you don't like the job, and you need to then focus on building wealth and creating passive income. And if you do have a job, then you need to also, if you love your job, you should always invest to make your money work hard and get financial education first in order for you to make money work hard. Otherwise, you can't make money work hard, because there are a lot of people out there with money sitting in the bank and they don't have the financial education to make that money work hard. So they just continue to stack up money, lose money, because inflation is high, and actually inflation is music to the ears of a master investor, because we take advantage of inflation. We want to have hyperinflation, actually, because it makes us wealthy faster, but it makes the poor poorer, or the one that is financially uneducated. That person could have money in the bank, it's making them poor because they can't keep up with inflation, so they actually losing money, paying money to have their money safe in the bank. So make sure that money is always moving from asset to asset. That's how we maintain the value of money, because otherwise money goes back to intrinsic value, which is zero. Every currency in the history of humanity has always gone back to its intrinsic value. There's a saying out there that says it's not even worth a continental, because they printed so much continentals that it just became worthless. So today, money is created with that, and we need to evolve as money evolves as well, and adapt and have flexibility with these new technologies that are being introduced on a daily basis to us. Then we need to also change and evolve. Artificial intelligence is just amazing, the times that we're living. We didn't have all the information and access to the entire world with a phone 50 years ago. Imagine how the world is going to be in the next 5 years. So start taking advantage of all the tools that we have available today to create the lifestyle that you desire and want, and create something great for the world. Solve problems in the world. There are so many problems out there because humans complicate things. And so if we can find something that can create some sort of simplicity into a problem and give them a solution properly through systems in a protected niche, then we will have created a profitable business, a profitable asset that is producing us passive income even while we're not working. And that's the holy grail, is to have assets that produce passive income for us so that we can enjoy life and do anything that we want. It's about experiences right now. It's about manifesting right now. Where do you want to see yourself in the next year, on the next 2 years? What is in your bucket list? What type of goals do we have on a daily basis? It's very important to have the radar, the GPS heading towards wealth, so that we can have total freedom. That's what we're doing as a wealthy entrepreneur and a master investor, to solve problems in return, because we're serving the masses, or we are being generous, we're giving employment to other people, we're solving problems to help the world become a better place, then we actually are getting the effect of when we give, we should also receive. It's a ripple effect that comes all the way around back to us. So the more we serve, the more we are generous, the more we become wealthier. All right, so 3 types of income. So we have earned income. You pay the highest on taxes with earned income. It's taxed at the highest bracket. And the laws are not in favor of earned income. Okay? And you can only work so hard per day to make money. And so you only have 12 to 18 hours to work. The other 4 hours, 8 hours, you need to sleep, eat, etc. So a lot of people don't understand that there are more incomes that we can utilize to become wealthy and make money and pay our bills. The second type of income is capital gains income, which is the first type of income when it comes to investing. We get 2 types of income when it comes to investment income. Capital gains income as number 1, and number 2, passive income. It takes financial education to get capital gains income and, of course, passive income, or known as positive cash flow. Capital gains income is taxed at a higher bracket than passive income. However, there are certain exceptions where we can minimize taxes with capital gains income. Capital gains income, it is taxed at a much less ratio than earned income. Earned income is taxed at the highest bracket. However, capital gains income have certain exceptions in the law that we can follow the requirements to minimize and roll over and defer taxes, rolling over the gains of the transaction of selling an asset, that we can roll that into a new and bigger asset. Then we can defer taxes on real estate, in the real estate asset class. There are 5 different asset classes that exist: real estate, businesses, crypto, paper assets, commodities. The third type of income, in capital gains income, is obtained when we purchase something at a certain price and we sell it for a higher price. That is the capital gains right there, because that gain is what we call capital gains income. And then we have passive income as the third type of income, which is taxed at the lowest bracket. And it's the best type of income because it gives us total freedom. It comes from assets that are producing passive income for us on autopilot, because the business is a sound system of systems working hard for us. Even when we're not present at any given time to make that passive income, it's working for us on autopilot. So combining good debt with passive income is the holy grail, because we are creating tax-free cash flow, and as much we are getting wealthy for free because we're reaching infinite return on investment. And we're tapping into the velocity of cash flow, which means that we have acquired or invested into a cash flow and asset. That's number 1. There are 5 steps to the formula of velocity of cash flow. Number 1, acquire or invest into a cash flow and asset. Number 2, recoup the down payment. Move the cash flow generated from the asset into a new cash flow and asset. And number 5, repeat the formula. And we do that over and over again, and then we will reach the 3 E's of a master investor. We talk about them all the time. Number 1, financial education. Number 2, experience. And number 3, excess of cash flow. We are a master investor when we are receiving passive income from our assets, and we are thriving and living through our assets' income. Passive income that is coming in, and capital gains income. We're paying our bills, living our life. Everything that we do is being paid from our asset column. Okay. Okay, now we're going to talk about how to analyze investments. We're going to speak about the ratios that are important when it comes to investing. The numbers tell a story. If we can learn to read financial statements, we can see what is happening within any company or investment. Master Investor will teach all how we can use financial ratios to manage our businesses. Whether it is an investment in the stock of a company or purchase of a real estate, we always analyze the financial statements. We can determine how profitable a business is or how highly leveraged a business is just by looking at its financial statements and calculating financial ratios. For a real estate investment, we calculate what the cash-on-cash return will be based on the amount of cash we need to spend for the down payment. The bottom line always comes back to financial literacy. This chapter will cover some of the important concepts in thought process every sophisticated investor goes through in choosing investments for their financial plan. Number 1, financial ratios of a company. Number 2, financial ratios for investing in real estate. Number 3, natural resources. Number 4, good debt or bad debt. Number 5, investing and saving. Financial ratios of a company. Gross margin percentage is the gross margin divided by sales, which tells us what percentage of sales is left after deducting the cost of goods sold. The gross margin is sales minus the cost of goods sold. If the gross isn't there, there will be not net income. How high the gross margin percentage needs to be dependent on how a business is organized and the other costs it must support. After calculating the gross margin percentage, for example, convenience stores still have to rent the building, pay the clerks, the utilities, the taxes and government permit fees, pay for wasted or damaged goods, and a long list of other expenses. Then they have to have enough left over to give the business owner a good return on his or her original investment. For internet e-commerce sites today, these additional costs are usually much lower, so these businesses can afford to sell and make profit with the lower gross margin percentages. That way, we need to understand how important it is to start building our digital assets online, right? And if you want to have an e-commerce store or some sort of online or digital asset, then get started, because the overhead is a lot lower than a physical store. We have a much faster route to building financial freedom when we attack the internet. The higher the gross margin, the better. So gross margin percentage equals gross margin sales cost for sold products divided by sales. Net operating margin percentage tells us the net profitability of the operations of the business before we factor in our taxes and cost of money. EBIT stands for earning before interest and taxes or sales minus all costs of being in that business, not including capital costs, interest, taxes, dividends. The ratio of EBIT to sales is called the net operating margin percentage. Business with high net operating margin percentages are typically stronger than those with low percentages. The higher the net operating margin, the better. Net operating margin percentage equals EBIT divided by sales. Operating leverage is the percentage of fixed cost in a company in a company's cost structure. It can be calculated by dividing contribution by fixed cost. Contribution refers to the gross margin, sales less cost of goods sold, minus variable cost, all costs that are not fixed, costs that fluctuate with sales. Fixed costs include all sales, general and administrative costs that are fixed and do not fluctuate based on sales volume. For instance, the labor costs related to full-time employees and most costs related to our facilities are generally considered fixed costs. Some people refer to this as overhead. A business that has an operating leverage of 1 is generating just enough revenue to pay for its fixed costs. This will mean that there is not return for the owners. The higher the operating leverage, the better. Operating leverage, contribution divided by fixed cost. Financial leverage refers to the degree to which an investor or a business uses borrowed money, total capital employed is the book or accounting value of all interest-bearing debt, leave out payable for goods to be resold and liabilities due to wages, expenses, and taxes owed but not yet paid, plus all owners' equity. So if we have 50,000 of debt and 50,000 of shareholders' equity, our financial leverage will be 2, or 100,000 divided by 50,000. Financial leverage equals total capital employed, debt plus equity, divided by shareholders' equity. Total leverage is the total risk that a company carries in its present business. Total leverage tells us the total effect a given change in the business should have on the equity owners, common shares, or general partner. Total leverage is calculated by multiplying the operating leverage by the financial leverage. If we are the business owner and therefore on the inside our company's total leverage is at least partly under our control. If we are looking at the stock market, total leverage will help us decide whether we want to invest. Well-run, conservatively managed, publicly traded American companies usually keep the total leverage figure under 5. So total leverage equals operating leverage times financial leverage. Debt to equity ratio measures just that, the portion of the whole enterprise, total liabilities, financed by outsiders in proportion to the part financed by insiders' total equity. Most businesses try to stay at a ratio of 1-to-1 or below. The lower the debt to equity ratio, the more conservative the financial structure of the company. Debt to equity ratio equals total liabilities divided by total equity. Quick and current ratios tells us whether the company has enough liquid assets to pay its liabilities for the coming years. If a company doesn't have enough current assets to cover its current liabilities, it is usually a sign of impending trouble. On the other hand, a current ratio and quick ratio of 2-to-1 is more than appropriate. So quick ratio equals liquid liabilities divided by current liabilities. Current ratio is current assets divided by current liabilities. Return on equity is often considered one of the most important ratios. It allows us to compare the return this company is making on its shareholders' investments compared to the alternative investments. Return on equity equals net income divided by average shareholders' equity. What do the ratios tell us? Master Investor encourage all to always consider at least 3 years of these figures. The direction and trend of margin percentage leverages and returns on equity tell me a lot about a company and its management and even its competitors. Many published company reports do not include these ratios and indicators, so a sophisticated investor learns to calculate these ratios or hires someone knowledgeable to do so when they aren't provided. A master investor understands the terminology of the ratios and can use the ratios in evaluating the investment. However, the ratios cannot be used in a vacuum. They are indicators of a company's performance. They must be considered in conjunction with analyzing of the overall business and industry. By comparing the ratios over at least a 3-year period, as well as with other companies in the same industry, we can quickly determine the relative strength of the company. For example, a company with excellent ratios over the last 3 years and strong profits could appear to be a sound investment. However, after reviewing the industry, we may find out that the company's main product has just been rendered obsolete by a new product introduced by the company's main competitor. In this instance, a company with a history of a strong performance may not be a wise investment due to its potential loss in market share. While the ratios may appear complicated at first, we will be amazed at how quickly we can learn to analyze a company. Remember, these ratios are the language of a master investor. By educating ourselves and becoming financially literate, we too can learn to speak in ratios. Financial ratios for investing in real estate. When it comes to real estate, a master investor has two questions. Number one, does the property generate a positive cash flow? Number two, if yes, have we done our due diligence? The most important financial ratio of a piece of a real estate to master investor is our cash on cash return. Cash on cash return equals positive net cash flow divided by the down payment. Let's say we buy an apartment building for $500,000. We put $100,000 down and secure a mortgage for the $400,000 balance. We have a monthly cash flow of $2,000 after all expenses and the mortgage payment are paid. Our cash on cash return is 24% or $24,000. 2,000 times 12 months divided by 100,000. Before buying the apartment building, we must decide how we will purchase it. Will we buy it through a C corporation, an LLC, or a limited partnership? Consult with our legal and tax advisors to make sure that we choose the entity that will provide the most legal protection and tax advantages to us. Due diligence. In our opinion, the word due diligence are some of the most important words in the world of financial literacy. It is through the process of due diligence, the careful evaluation of a potential investment to confirm all material facts, that a sophisticated investor sees the other side of the coin. When people ask us how we find good investments, we simply reply, we find them through the process of due diligence. That is how Master Investor does it. We are more than an investment management company. We also invest in assets that produce passive income and capital gains income. We're actively investing as we speak. And so we are helping you understand how money works and how we are also investing so that you can duplicate what we're doing and can get ahead financially, can build true wealth in the life that you desire. Everybody's wealth number is different because we have different standard of living. It's about what do you like to have right now and how would you be happy? How much do you want to have? What are the things that you want to experience? And so we're going to build the asset column that will provide enough passive income and capital to gain income to fulfill and help you thrive in that lifestyle. The faster we're able to do our due diligence on any investment, regardless of whether it is a business, real estate, a stock, or bond, the better able we will be to find the safest investments with the greatest possibility for cash flow or capital gains. Once we have determined that a piece of real estate will generate positive cash flow, we still need to perform due diligence on the property. Okay. I think I need to read that again because my battery ran out. So let me just take this off real quick and connect my microphone. Okay. Let me go back to here. Master Investor has a checklist of due diligence that we use to do our investment analysis when it comes to real estate. Okay? It is a very thorough and includes items that did not exist years ago, such as phase 1 environmental audit. If we have questions about the property, we often bring in the experts and have our attorneys and accountants review the deal. Due diligence checklist. Number 1, current rent roster with paid to dates. Number 2, list of security deposits. Number 3, mortgage payment information. Number 4, personal property list. Number 5, floor plans. Number 6, insurance policy agent. Number 7, maintenance service agreement. Number 8, tenant information, leases, ledger, cards, applications, smoke detectors, forms. Number 8, list of vendors and utility companies, including accounting numbers. Number 9, a statement of structural alterations made to the premises. Number 10, surveys and engineering documents. Number 11, commission agreements. Number 12, rental or leasing agreements. Number 13, easement agreements. Number 14, development plans, including plans and specification as built, architectural, structural, mechanical, electrical, and civil drawings. Number 15, governmental permits or zoning restrictions affecting development of the property. Number 16, management contracts. Number 17, tax bills and property tax payments. Number 17, utility bills. Number 18, cash receipts and disbursements journals pertaining to the property. Number 19, capital expenditure disbursements records pertaining to the property for the past 5 years. Number 20, income and expense statements pertaining to the property for 2 years prior to the submission date. Number 21, financial statements and state and federal tax returns for the property. Number 22, a termite inspection and form and content reasonably satisfactory to the buyer. Number 23, all other records and documents in seller's possessions or under seller's control which will be necessary or helpful to the ownership, operation, or maintenance of the property. Number 24, market surveys or studies of the area. Number 25, construction budget or actuals. Number 25, tenant profiles or surveys. Number 26, work order files. Number 27, bank statements for 2 years showing operating account for property. Number 28, certificates of occupancy. 29, title abstracts. 30, copies of all surviving guarantees and warranties. And 31, phase 1 environmental audit. A master investor includes investments in the earth, natural resources as part of portfolio. We invest in oil, gas, coal, and precious metals, and just to name a few, and as much as digital assets such as book like this one. Master investors strongly believe in the power of gold as a natural resource. Gold has limited supply. As master investor company educates people throughout the centuries have cherished gold. Master investor also believes that owning gold attracts other wealth to us. So remember, there are 5 different asset classes. Learn how to diversify among those asset classes. Good debt or bad debt. Master investor recognizes good debt, good expenses, good liabilities. How many rental houses can we afford to own where we lose $100 per month? Of course, not too many. How many rental houses can we afford to own where we earn $100 per month? As many as we can find. Analyze each of our expenses, liabilities, and debts. Does each expense, liability, or debt apply to a corresponding income or an asset? If so, is the cash flow coming in from the income or asset greater than the cash flow going out for the expense, liability, debt? For example, let's say a friend has a mortgage on an apartment building for $600,000. He pays out $5,500 each month in mortgage and interest payments. He receives $8,000 rental income each month from his tenants. After all the expenses, all other expenses, he has a net positive cash flow of $1,500 each month from the apartment building. We will consider Jim's mortgage a good debt. Investing and saving. A master investor understands the difference between saving and investing. All right. That's what I have for you today. I'll see you on the next video. Thank you for having me. Bringing the good and bad news of money, the business principles that work in all economies. Remember, today money is debt. So that's why we encourage everyone to use good debt to become wealthy for free. Bye for now. Stay great and wealthy.